I'm going to expose outright calls versus debit spreads in this video. Now, some people are going to absolutely hate me because I'm exposing the business, but we'll cover more today, Stonkomania 130, but I'm just going to show you from a visual, and it's pre-market, it's 8:20 right now, of why I prefer doing outright calls on most plays versus call spread. So let's say, okay, and we're going to use current prices, everything is real time. Let's say I want to get bullish, and right now pre-market we have to look at SPX because individual stocks options aren't open. So let's say I am bullish on the SPX, the S&P 500, and let's say I think it trades over 6,700. Well, guess what? We're already there. We're at 6,711 right now. So let's write that real big, 611. So let's say, I got my big head in the way here, let me move it. Let's say I'm bullish, right? And maybe I did this trade yesterday and great, the stock is up, everything's working good. Let's say I did the 669, I bought those calls, okay? And I sold the 6700. So I'm doing a call vertical spread and I'm doing it $10 wide, okay? So let's say I did this trade and you can see it's about 930 debit. So that's the 690, 6700. So 10 point wide, and now it's about 925 debit. My big head's in the way again, 925 debit. And you may be saying, Lance, why is it not at $10, which is the max value of this spread, right? Because we're in the money, and these options actually expire today, so there's not much time on them. Why can't I get $10 for this if I'm basically 11 points good? Because there's still volatility to where the stock can move up or down. So let's do another example, but this time, let's go out till, I don't know, let's do October 6th. So not too far away. And let's do the same trade. Let's buy the 6690 call. And let's sell the 6700 call. Now you can see here, my net debit for this trade is only about $8. But again, these options expire 4 days, not much. Why with the SPX at 6,711? They're in the money. Why aren't they at $10? Why are they only $8? Because there's still volatility in time that the SPX can move. So the better option would be, if you're right, on direction, and you did catch a big move higher, the best thing to do would be to just buy the outright call. And let's actually put this on a graph and see what that looks like. Now these are expensive options, so bear with me here because this is the only thing we could find pre-market. But let's actually plot of how the independent, the outright call moves. So intraday, you can see these options went as low as about $20 and as high as about, let's just say $40. We're not going to call it the top. So they moved up around 100%. If I did the call spread, and I don't think we can copy that, but we can try here. Why not? Let's try copying the call spread. I don't think we'll be able to chart that, but let's give it a go. Why not? You can see the call spread. This is a $5 wide call spread. Barely moved, right? It moved not much throughout the day, right? Compared to the outright call. So when you do buy the call, and let's look at an individual stock, you have more liquidity, meaning you'll be able to get in and out easier. And then if you get the bigger than expected move, you're gonna make way more money than limiting your gains on the call spread. So let's look at an outright call, and let's do a stock maybe like, let's do maybe like a stock like Alibaba, right? So let's look at a stock like Alibaba. You know, again, it's a high dollar stock, but let's take a look at it here. So let's say I wanted to do the Alibaba outright calls, right? And let's just go to October monthly expiration, okay? They're pretty liquid. You know, it's a big stock. It trades a lot. And if I want to do with the stock at, let's say, 182.5, well, actually right now, pre-market, it's 187 and change. But let's say, because the options are going to be priced, let's say at 182.78. So let's write that down, 172.78. And let's say I did the 180, 185 call spread. Let's see how much that is, right? They're in the money. Shouldn't it be, you know, shouldn't it be near $5 at max value? So let's look. 180, 185. So you can see my net debit is only about 230. Why? Why is that it? And let's say I go deeper in the money. Let's say, you know what, I'm super conservative. I want to look good for my win rate, my spreadsheet, and I do the 170, 175 call spread. Now these are, you know, again, or 180 call spread. We'll do it 10 points away. These are in the money. They should be right near $10, right? Well, let's take a look. 650. Why aren't they $10? If I did a call spread, I'm right, I'm supposed to have a max value. Again, time and volatility are playing into that call spread. So once again, the better option would be just buying an outright call. Again, better liquidity and better percentage moves, you're not capped on those gains. So again, let's look at one more example. Let's say I want to use in that stock APLD, right? Which now the calls are deep, deep, deep in the money, as you can see. So with this stock, you might be saying, Lance, why aren't you doing a call spread? Well, let's say I do the 29.30 call spread, right? And it's anywhere between, let's say, 30 cents. I always have to be aware when I do a call spread, yes, I'm risking $30 to make $1 technically, so I'm tripling my money if I'm right. But I also have to be aware that volatility in the stock is very high. So I can be right, and let's say the stock goes to $30 by October, right? Let's say next week it goes to $30. I'm not going to be able to get the full dollar for the spread. I might only be able to get 60 cents, which is still 100%. It's a double. But what if the stock goes to $35 or $33.50, let's say? My max gain is capped at $1. And again, I might not even get $1. I might get maybe 90 cents if I'm lucky or so. If I buy the outright call, and that was at what? 280, and it goes to $33.50. It goes to over $10 plus I still have time and volatility working in my favor. So it'll be at minimum $10. It might be $11. It might be $12. And I have instant liquidity on when I want to get out. Now, in my opinion, the best time to use vertical spreads, okay, is in a stock where you're not looking for a crazy move, kind of like a grind higher move. That's like a stock like Nvidia recently. Because when you spread out your trade, you limit your upside. Yes, you also limit your net debit, so the price you pay for the option. But unless it's a very expensive option, which I get, if you have a small account especially, you do have to use spreads if you want to trade, you know, bigger stocks, Apple, Microsoft, Google, Amazon, Nvidia, AMD. I totally understand that. But when you are trading a stock that you're not looking for news, so to speak, where you don't want to limit your gains. So when you're looking for news, you're looking for analyst upgrade, buyout, earnings event, an investor conference. Again, mostly stuff from the news flow scanner because, again, they're not doing spreads. They're buying outright calls. And yes, they have way more money. They're spending hundreds of thousands, millions of dollars on orders. I totally understand that, and that's a case you can make. But when you're looking for a stock to slowly kind of grind up that has high implied volatility like NVIDIA, where it is, yes, you have big up days and you have down days and you kind of have big up days and slowly grinding up, as you can see, right? Where you have a pop, consolidation, a pop, consolidation, a pop, consolidation, right? And if you have outright calls, you're gonna have to time these pops and sell perfectly. Because if not, this can fade you out. Because what happens when a stock fades? Vol gets crushed, right? And those options go down in value. So by selling the upside call, that out the money call option will go down in value. The in the money option will act as a stock replacement and move almost one-to-one with the stock. So let me show you what that looks like here. If I have NVIDIA, and you can look here, let's look at the October options for NVIDIA. And you can see the October options, let's say the 200 calls are about $1.50. So break even on these options will be 201.5, right? 201.5 on NVIDIA. Those are expensive because you basically need about a 12-point move in NVIDIA in the next 15 days. The 190 calls are about 460. So let's look, 190 plus 460, that's 194.60 as your break even. If you were to buy those 200 calls, your break even is 201.50. So you're gonna get better probability. You're gonna get a cheaper trade, technically, and unless you're expecting NVIDIA to shoot up to like 220, it's a pretty smooth trade because the market makers are jacking up implied vol and the out the money options in NVIDIA because the market maker move is 12 bucks. So what I like to do when I do a call debit spread is use the market maker move as a place to sell the short call. So what that looks like is this. Let's say NVIDIA goes to 200, okay? Let's say it goes to 200 at October 17th or by October 17th. And I buy the 190 calls at 460. If it goes to 200, those calls go to 10 bucks. I double my money. So I 2x my money. Yay, that's great. If I buy the 200 calls, and let's say I just get a slow grind higher to 200 by October 17th or on October 17th, these calls are gonna be zero, right? Because they expire, stock goes to 200, they go down from 150 to zero because the stock is at 200. Let's say the stock goes to 250 cents. Those calls will be worth 50 cents. So they still lose money in the options, even though the stock moved to 200. So that's why on the kind of expensive stocks and the slow grinding stocks, using the short call option is wise. And oftentimes it can help you stay in the trade longer because when you get these fades, the short option is going to lose value. So therefore your trade is not going to move down from a P&L perspective if you're long a call debit spread. If you're long an outright call, yes, you're going to see your P&L lose value as the stock goes sideways, depending on what strike you buy. So let's look at, though, one more case scenario in NVIDIA. And let's say I wake up tomorrow, or you wake up, or over the weekend, or NVIDIA has some new news, and NVIDIA goes to 220 a share. Okay, massive move. Oh, everyone's talking about it. Well, those 190 calls I bought at 460 are going to go from 190 to 30 bucks, right? And they're going to be literally one-to-one with the stock at 200. So 30 bucks. Great. Okay, and let's do the percentage math on that just so we have a full picture here. So let's do a full picture of that. I buy them at 460, huge move. They go to 30 bucks. I'm so happy. I'm up 552%. That's fantastic, brother. Amazing, right? And again, you'll probably be able, again, to get out anytime, very, very liquid, right? No issues at all. Let's say, though, I do the 200 calls outright. Again, we're getting super bulled up here, but let's say I buy the 200 calls outright, and again, they cost $150, and we go to 220. So those options go from $150 to $20, right? 200 calls minus 220 is $20. So let's do the percentage gain on that. That's 1,233%. That's a big increase. And again, you have instant liquidity. So it really depends when you place these trades. If you're looking for a slow grind higher, an expensive stock, then yes, turn it into a call spread. If you're trading, though, a highly shorted stock, a short float over, let's say 10%, and earnings, it could be a catalyst. It can be a stock that just has high implied volatility, maybe like a BE, that can just move crazy out the blue, right? Then you're better off usually, most of the time, just doing the outright call. And depending on what strike you buy, if you want to eliminate some risk, do an in the money option or an at the money option. If you want to get freaky deaky in the NVIDIA example at the 200 calls where you want to aim for that, 4-digit winner or that massive, kind of potential, then buy the cheaper out the money option. But your probability when you go out the money is going to go down. The probability goes up when you buy a deeper in the money option. And if you want to win a lot, just do debit spreads all the time. The issue is, again, you're going to win usually smaller, and you're not going to have as great as liquidity as you would buying the outright call. So again, trading is not about winning, having a high winning percentage. That's baseball, right? Getting base hits. It's not about that. I know it sounds crazy because everyone has lied to you and told you, I have a 90% win rate. It's not about that when you're trading options, specifically in individual stocks that can have news, okay? Because when you lose, you're gonna lose bigger. Now, it is about when you are right, capitalizing on the biggest ROI possible. Meaning, let's say you have 9 losers in that NVIDIA example. Well, that one winner is still going to have you up 300%. So, sounds crazy, but you can win 1 out of 10 times and still be up. That's amazing. Again, it's not about being right. It's about milking each trade for the highest possible return possible. After all, that's why you're buying options, is to try to risk the littlest amount of money possible to make the most money possible on that risk. So no one else is going to tell you this stuff, but I will. Why? Because I've traded with a small account. I've had to grind year and year and year and year out. It's not about being right. It's about maximizing the highest ROI possible, because you can have 1 or 2 big trades like we did a few weeks ago, and that can make your whole month, your whole year. And you can have lots of winning trades and a high probability and a high winning percentage, and then you can have a couple losses, and then they wipe out your whole year. So hope this video helps when to use outright calls or when to buy long calls versus when to do call spreads. And again, I'm not hating on call spreads. I think they have their time and place, especially on those kind of bigger stocks that grind higher. But I also want you to know you are limiting your upside. And when you trade, especially the news, you never want to limit your upside. If you just want to trade the SPY, the QQQs, and do spreads and try to hit base hits, I think they're totally fine because those are penny wide options and great liquidity. But if you really want to make that big possible move, do the outright call. Make sure you like, subscribe, leave a comment, and we'll cover more on this on Stonkamania 130. We have a new theme song debuting.